Welcome to today's Explainer. We've got a fascinating and frankly pretty intense set of data to walk through today. We're going to decode the massive economic tug-of-war that is actively pulling at your wallet right now. We're talking everything from surging inflation to the squeeze in the housing market and, crucially, what it all means for the Federal Reserve. So here's our roadmap for today. We'll start with why inflation is surging again, then look at the Fed's dilemma, the housing market squeeze, the reality for everyday consumers and job seekers, and finally, what to look out for next week, plus a fun National Salad Month hack to cleanse the palate. All right, let's just jump right into the big question on everyone's mind. Why are interest rate cuts, the ones everybody was banking on just a few months ago, suddenly looking so incredibly uncertain? To figure that out, we really need to dig into the raw data and see exactly where all this pressure is coming from.
Section 1. Inflation surges again, the heat is on. We're seeing intense pressure right out of the gate. April's inflation data came in surprisingly hot. Headline inflation just hit 3.8% year over year, and month over month, it's up 0.6%. So what's driving this spike? A huge chunk of it comes down to rising gas and fuel prices linked to the conflict in Iran, along with higher food costs. Honestly, food and energy made up more than half of this monthly increase. But here's the really crucial takeaway. Even core inflation, which strips out those bouncy, unpredictable food and energy sectors to give us the real underlying trend, came in hotter than expected at 2.8% annually. That tells us this inflation heat isn't just a temporary blip, it's sticky.
And it's definitely not just consumer prices feeling the squeeze. Wholesale prices are getting hit hard too. The Producer Price Index, or PPI, just jumped 1.4% in April. That is nearly triple what economists were expecting. Year over year, it's up a staggering 6.0%, again driven largely by energy and gas costs. Even the core PPI rose 1.0% for the month and 5.2% annually. Now, why does this wholesale pressure matter so much to you and me? Well, because businesses rarely just absorb those extra costs, right? The pressure builds up at the foundational level, and that inevitably trickles down to what we pay at the grocery store, the gas pump, literally everywhere.
Section 2. The Fed's Dilemma, a high-stakes balancing act. The Federal Reserve is currently caught in an impossible tug-of-war. On one side, you have this persistent, sticky inflation, which screams for keeping interest rates higher for longer to aggressively cool down the economy. But then, on the exact opposite side, we're seeing early signs of weaker employment data and a slowing labor market. That side of the equation is basically crying out for immediate rate cuts to prevent an economic downturn and keep people in their jobs. It's a massive, high-stakes balancing act. Leaning too far in either direction could seriously trigger a crisis.
Adding some serious drama to this dilemma is a major leadership change. The Senate just confirmed Kevin Warsh as the next chair of the Federal Reserve, taking over for Jerome Powell. Whenever you get new leadership, you introduce a whole new level of unpredictability. Because of this, the markets are going to be hyper-focused, hanging on his every single word leading up to his first official Fed meeting on June 16th and 17th. Every comment he makes between now and then is going to be heavily scrutinized for clues on where rate decisions are actually heading next.
Section 3. Housing market squeeze. Inventory versus prices.
So, with inflation keeping borrowing costs high, how is real estate reacting? Let's check out the latest numbers. Existing home sales edged up just a tiny 0.2% in April. There is a glimmer of good news, though. Inventory actually rose 5.8% from March, bringing us to 1.47 million homes. But here's the catch, and why this matters for you. Despite that slight improvement, the market is still deeply undersupplied compared to historic norms. We only have about a 4.4-month supply of homes right now. That means competition for the few available houses is still just incredibly fierce. And because of that historic undersupply, we arrive at a truly jaw-dropping number, $418,000. That's the median home price for April, which is up 2.1% month over month. The big takeaway here is that even with high borrowing costs putting major downward pressure on demand, the sheer lack of available homes is keeping prices stubbornly, frustratingly elevated. It's just a classic, brutal supply and demand squeeze for anyone trying to enter the market today.
Section 4. Consumers and job seekers, the Main Street reality.
Despite higher fuel costs eating away at daily budgets, American consumers are showing some incredible resilience. Overall retail sales rose 0.5% in April, which perfectly matched expectations. But even more telling is the core control group. This strips out unpredictable things like auto and gas sales to give us the true heartbeat of consumer spending, and it feeds directly into GDP calculations. Well, it also rose 0.5%, which was a stronger than expected result.
Bottom line, people are clearly still spending and keeping the economic engine running.
However, the labor market tells a much more complex story. We're starting to see some real strain beneath the surface. While new unemployment claims look relatively low at around 211,000, that number is actually a bit deceptive. It turns out, a lot of displaced workers are turning to freelance or gig work instead of filing for traditional unemployment benefits. The real red flag here is continuing unemployment claims, which are staying uncomfortably elevated at 1.78 million. What you really need to take away from this is a harsh reality. Once someone loses their job in this current economy, it is taking them significantly longer to find a new one.
Meanwhile, the technical indicators in the bond market are reflecting all this underlying tension. Mortgage bonds have dropped below key support levels, and critically, the 10-year Treasury yield has just broken right through a major resistance ceiling of 4.58%. Why does this matter to you? Well, because Treasury yields are basically the engine behind mortgage rates. With that ceiling officially broken, it's a strong signal that higher borrowing costs could persist for the foreseeable future, directly hitting the wallets of prospective homebuyers.
Section 5. Looking ahead and bonus hack.
So here is exactly what you need to watch out for in the week ahead. Monday kicks off with the NAHB Builder Confidence Report. Then on Tuesday, we get April's pending home sales. But Wednesday is absolutely the climax of the week. That's the release of the Federal Reserve's latest meeting minutes, which always have massive potential to move the markets. Finally, Thursday brings us new home construction data and the latest jobless claims. Honestly, housing and the Fed are absolutely taking center stage this week.
Okay, now for a quick palate cleanser. It is National Salad Month, and frankly, after digesting all that heavy economic data, we could all use a breather, right? So let's step away from the charts for a minute with a fantastic pasta salad recipe, courtesy of the Food Network.
This is super simple, absolutely delicious, and just perfect for the warmer weather we're getting. First, boil some gemelli pasta until it's al dente. Then, whisk up a quick vinaigrette with olive oil, red wine vinegar, Dijon mustard, and a little honey. After that, just toss in some vibrant, fresh veggies, Persian cucumbers, cherry tomatoes, crisp celery, radishes, sweet corn, a little shallot, and a hit of fresh parsley and dill. The absolute most important part, let those flavors meld together for at least 30 minutes at room temp or up to 8 hours in the fridge before you actually serve it. Trust me on that one.
And that brings us right back to the big picture. As we close out today's explainer, I really want to leave you with the ultimate question. How is incoming Fed Chair Kevin Warsh going to navigate this insanely tense economic tug-of-war between hot, sticky inflation and a cooling labor market? Is he going to hold steady, or will the immense pressure force a pivot? Keep a really close eye on the data we discussed today, because that's going to be the key to his decision. Thanks so much for joining me, and I'll catch you in the next explainer.